From a VC's perspective, there are some relatively simple maths which tell you whether a company is venture fundable or not. The whole purpose of VC money is to invest in things that are high risk. High risk means that of the 20 or 30 companies that we may invest in every year, maybe half of them aren't running in 3 or 4 years' time. Maybe another 10 or 12 of them, or 10 of them are coming along, maybe 5 of them are doing okay, and one of them is doing amazing. And you have this thing called a power law. The power law basically says that actually the one company that's doing amazing pays for all of the other companies. The whole model of VCs are finding these rare, big, successful companies. If you're in $100 million fund, you have promised to return 300 million in 10 years' time. And so that probably means that you need to have 3 companies that will return 100 million each. And if you're only owning 10% of that company has to be worth $1 billion. I think the real problem is there's a gap of funding for slower growth. If you had a slower growth business idea, you would go to your bank and your bank would give you 100K. And that might be enough to start getting some contracts and some money in. But all of that kind of smaller funding has disappeared, particularly with millennials, is if you don't have a house. Like a lot of the bank, loans would be like, put your house up for collateral. It feels like your only option left is to go with VC. It's a real shame. And I really do wish actually there were more routes of funding that were aimed at smaller businesses, because VC kills really, really good companies. If you take money from a VC, you are committing to building a massive business.